In this video, we're going to talk about a professional trader and author who's achieved a ton of success throughout his career, which started back in the 1970s. Over the years, he's written a bunch of influential books and has made a huge impact on the trading community. One of his key contributions came in 1989 when Dr. Alexander Elder developed an indicator called the Elder-Ray Index to enhance his trading strategies. He named it Elder-Ray to emphasize how it allows traders to see through the market, kind of like an X-ray machine. The Elder-Ray Index combines a 13-day exponential moving average, EMA, with two important components: bull power and bear power. Bull power measures how strong the buyers are in pushing prices above the EMA, while bear power evaluates how strong the sellers are in pushing prices below it. Basically, the Elder-Ray Index helps traders assess whether most market participants are buying or selling. Fast forward to 2020, and now we have the Open Interest Inflow and Outflow Indicator by Lux Algo. This modern tool is designed to better navigate today's more complex market dynamics, offering a more detailed approach to analyzing market activity and sentiment. It helps traders make more informed decisions about when to go long or short. In this video, we'll dive into exactly how this indicator works. To get started, we're going to use TradingView, the platform I'll be using for this demo. If you need to sign up, there's a link in the video description to help you get started. Once you're logged into TradingView, you'll want to pull up the 15-minute time frame of BTC USD. I'm using the Bitstamp chart, but you can choose the one that works best for you. Next, click on Indicators and search for Open Interest Inflows and Outflows. You'll want to select the one by Lux Algo. The Open Interest Inflows and Outflows Indicator is a tool designed to give traders deeper insights into market dynamics. By analyzing open interest changes and combining that with price sentiment, it shows the balance between buyers and sellers. It also gives you insights into trend direction and market momentum. As you can see, it's a super simple indicator with just a few key components. A histogram showing open interest flow sentiment, a gray line representing price sentiment, and an open interest sentiment correlation. Looking at the indicator, you'll notice a zero level, which acts as the central axis for its analysis. At this point, you might be wondering exactly what each of these components does, so let's break them down one by one. The histogram, or open interest flow sentiment, shows the difference between new positions being opened, called inflows, and existing positions being closed, called outflows. When the histogram is above the zero level, it means more traders are opening new positions, signaling increased market interest and potentially bullish momentum. When this happens, you'll want to focus on long positions. If you had any short positions, it's time to close them. On the other hand, if the histogram is below the zero level, it means more traders are closing their positions, indicating decreased market interest and possibly bearish momentum. In this case, you'll want to exit any long positions or focus on short positions. Next, we've got the gray line, which represents price sentiment. This measures the balance between buying pressure and selling pressure in the market. When the gray line is above the zero level, it means buyers are stronger than sellers, creating upward pressure on prices. If the line dips below zero, it suggests sellers are in control, leading to downward pressure on prices. Now, let's talk about the open interest sentiment correlation. This shows how the open interest flow sentiment, the histogram, correlates with other data sources like price sentiment, price itself, volume, or unbalanced volume. By default, it's set to correlate with price sentiment. When the correlation is above zero, it adds extra confidence to the signals from the open interest histogram, reinforcing the current trend. If it's below zero, it suggests that the open interest changes aren't aligned with the price movement, signaling a potential shift. Another feature of this indicator is the table that shows the money inflow and outflow as percentages. The money inflow percentage represents how much money is flowing into the market for the most recent candle, while the money outflow percentage shows how much is flowing out. Remember, these numbers reflect just one candle, so if you're using the 15-minute time frame, the numbers will change as you move through different candles. Now, the settings for this indicator are pretty straightforward. I'm going to use the default settings for the strategy I'm showcasing today. The only tweak I'm making is disabling the open interest sentiment correlation and changing the price sentiment color to white with 100% opacity. Before we get into the conditions for taking a long position, it's important to note that this indicator is based on Dr. Alexander Elder's Elder Ray concept. According to Elder, the high price of any candle represents the maximum power of buyers, while the low price represents the maximum power of sellers. Elder uses a 13-period EMA to represent the average price consensus. Bull power checks if buyers can push prices above that consensus, while bear power checks if sellers can push prices below it. This concept is used in the open interest flow sentiment histogram and the price sentiment, white line, to help identify potential shifts in market sentiment and momentum. Let's go over the first strategy now. We're going to add an indicator called the PT Market Beacon, a custom indicator that I'm going to show you how to combine with the open interest inflows and outflows indicator for a simple but powerful strategy. First, double-click on the PT Market Beacon indicator, then head to the Style tab. From there, you'll want to disable the second buy label, the sell label, the BS plot, the candle boxes, the labels, and the line fills. After that, click OK. The PT Market Beacon is a buy-sell indicator that uses advanced price action techniques to generate super accurate long and short signals. To take a long position using this strategy, the first condition is that you need a long signal printed by the PT Market Beacon indicator. This will mark the entry candle. Then, look down at the histogram from the open interest inflows and outflows indicator. The most recent bar should be green, which indicates that more traders are opening new positions and increasing market interest, potentially boosting bullish momentum. The price sentiment, white line, should also be above 0, signaling that buyers are stronger than sellers. Lastly, check the money inflow value. It should be at least 80%. Once these conditions are met, you'll enter a long position, placing the stop loss below the most recent swing low. If the swing low is too far down, you can align the stop loss with the top of the long signal label, which my backtesting shows increases the chances of the stop loss not getting hit. For the take profit, set it at 1.5 times your risk and let the trade run. As you can see, this trade was profitable. Now, to take a short position, you just reverse everything we did for the long position. Here's the first condition. You need a short signal from the PT Market Beacon. Then, the histogram should be red, indicating more traders are closing their long positions, suggesting bearish momentum. The white line should be below 0, meaning sellers are stronger than buyers. Lastly, the money outflow value should be above 80%, confirming the trade. Set your stop loss below the short signal label and set your take profit at 1.5 times the risk, and that's how you can take a short position. This strategy also works well for backtesting. The PT Market Beacon is a private indicator, so if you want to get access, click the link in the description. There, you'll find options for lifetime membership and discounts on monthly plans. If for some reason you can't get the PT Market Beacon but still want to use the open interest inflows and outflows indicator in a strategy, you can try something like the Andean Oscillator by Alex Grover. It's not as profitable as the PT Market Beacon, but it's still a decent alternative. For this strategy, you'll need a buy signal from the Andean Oscillator, which happens when the blue line crosses above the orange line. Once you have the buy signal, the conditions for the long position are similar to what we just discussed. The histogram should be green, the white line should be above 0, and the money inflow value should be above 80%. Then, you can enter the trade. For a short position, just reverse the conditions. In conclusion, the open interest inflows and outflows indicator is a powerful tool that digs deeper than surface-level price movements. By analyzing both open interest and price changes, traders can gain valuable insights into market trends, validate potential breakouts, and even anticipate trend reversals. This video is not financial advice, and I'm not a financial advisor, so make sure to do your own due diligence before making any investment decisions. That's it for today's video. I hope you found it helpful. If you did, don't forget to leave a like and consider subscribing to stay updated. Thanks for watching, and I'll see you next time.